Hi, it's Greg Goernert, Vice President, Senior Investment Advisor, Canaccord Genuity Wealth Management and Goernert Wealth Management. Now, welcome to the show where we help you make sense of your financial world. Now, today, I'm going to be joined by Canaccord Genuity banking analyst Scott Chan for his views on the markets right now. Scott, welcome and thank you for joining me.
Thanks for having me, Greg.
Great. Hey, I'm glad you can make it. Glad this all worked out. Now, we just had the federal budget come out recently, and just want to talk about maybe some implications of the bank, maybe some housing implementation. What's your view on how the budget may or may not have affected the banking sector right now?
Yeah, I mean, to be honest, I don't think there was any materiality within the budget that would affect the banks. As you mentioned, like we were looking for some housing implications, and there was kind of noise going into it that they could add a capital gains tax on primary residences. A lot of pushback. Obviously, that didn't happen. The budget did have some incremental stuff in terms of modest tax on residences for non-domestic ownership, and certainly put forth more capital within the budget to increase the housing supply, to help slow it down. And even before the budget came out, OSFI has made some measures over the past few weeks to help stem the housing market, specifically increasing the stress tests on uninsured mortgages. That should have a modest impact on the growth that we've been seeing. The housing market is still red hot. February record numbers in terms of mortgage growth, but now with the current lockdowns, especially in Ontario and the extended lockdowns, we would expect a temporary slowdown in mortgage growth, but that pent up demand to increase in the spring and the summer months.
No, that's a good point. No, all of this is based upon the yield curve, and I know the banking sector in particular is reliant on the yield curve as far as their profitability. Where do you see the yield curve moving forward, and how do any potential changes in the yield curve affect your earnings outlook? First on the banking side, then on the insurer side.
Yeah, so the yield curve, rising rates and steepening the yield curve help both the life cos and the banks. If we start with the banks right now, and you see it with mortgage rates, as the yield curve or the 10-year yield curve has increased, we've seen 5-year fixed rates increase by the banks right now. And that has an impact of kind of slowing loan growth, but better profitability for the banks, better ROE. Mortgages are a great product for the banks, as you know. It's about 40 to 50% of each bank's Canadian portfolio, so an important earnings driver on that front. It does take a couple quarters for that to feed through the system in terms of that margin expansion that we're expected to see. When we look out into the fiscal Q2 results, Greg, you're probably going to see stable or declining margins still, just based on the overall low rates. If we look at the life co sector, I mean, I think the biggest driver is investor sentiment on rising rates in the yield curve. But rising rates definitely help out the asset side of the portfolio to help manage the long-term liabilities that they have. It also helps the investment portfolio in terms of earnings on surplus, just earning higher yields on capital. And it does improve the margin profile in a lot of the products that they issue as well. And again, with the banks, you're not going to see that for a couple of quarters, but the market is kind of pricing that in, as you've seen both banks and life cos outperforming over the last 2 quarters, and valuation multiples increase at the same time.
Okay, now that's a good point. Now let's just step south of the border, because you just put out a report on the U.S. mega banks, and there was a couple of surprises there. You want to talk a little about that, or I'd like you to talk a little bit about that.
Yeah, absolutely. I mean, the U.S. banks, mega banks that we track, reported phenomenal results, outpacing Q4 year-end results, which were very strong. So we think it's got very positive implications for the Canadian banks that report late next month, especially for the Canadian banks that have higher U.S. exposure. So in order to be TD, BMO, Royal, and CIBC. The biggest themes in the quarter were kind of threefold. One was credit. The credit environment, especially in the U.S. marketplace, is a lot better than anyone anticipated. So all the allowance builds they built up early last year at the start of the pandemic is actually reversing and benefiting the earnings profile of the U.S. mega banks. From the market sensitive side, obviously working in Canaccord Genuity, there's robust capital market activities, particularly down south in respects to trading, ECM, DCM, and a lot of the banks beat on that respect. The one challenging thing in the quarter, but the outlook is a bit better, is on the core lending business. Loan growth was negative quarter over quarter, so think of credit cards being really weak in this environment. A lot of people aren't spending. And in terms of the margin that we talked about, it declined quarter over quarter a bit more than expectations. But with that higher yield curve and rising rates and that product mix shift that we're going to see throughout the year, that outlook should be better going forward as well.
Interesting. Okay, so why don't we take back, looking forward now, 12 to 18 months, what are the big catalysts in the Canadian financial sector that you've got your ear in the ground to and looking forward on?
Yeah, that's a good question. There's several factors. I think the biggest thing is capital deployment. So through the pandemic, the one thing that people and certainly myself didn't think was that capital accretion would be increasing throughout this pandemic, and now it's at record high levels. Mm-hmm. And as you know, OSFI did halt dividend growth and share buybacks back in April at the start of the pandemic. To shore up capital for consumers and commercial clients. But at the excess capital positions today, and you saw the U.S. Fed do this, we think that's going to be a material catalyst on capital deployment once OSFI lifts restrictions. And we think it's going to be in the fall of this year. So dividend growth, going back to dividend growth, buying back stock, and then potential M&A. The banks have been very, very quiet and muted during the pandemic on M&A. Now that they've built up this record excess capital position, we would expect the Canadian banks to focus on market-sensitive businesses like asset and wealth management. And if you look to TD and BMO, who have the biggest scale in the U.S., to add potential scale in the U.S. with the PNC acquisition potentially.
Interesting. Well, hey, why don't we leave it there? Really appreciate you joining me today. Scott Chan, Canaccord Genuity, financial analyst. Thanks, Scott.
Thanks a lot.